In this video, I'm going to be reacting to Investopedia's 10 day trading tips for beginners. We're going to go through it. Let's get right into it. I'm Pat Mitchell. This is Fallout Shelter Podcast, and I've been a professional day trader for the past decade. I have taught over 30,000 traders. So I'm going to go over these 10 top tips for beginners. And we're going to get right into it. So let's get into the screens. Okay, so here we have 10 day trading tips for beginners. This is right from Investopedia.com. Investopedia.com is a resource that a lot of very new traders use to figure out the markets at the beginning, understanding how they work. One of the issues that I have with Investopedia is a lot of the information that they're giving you is like some of it isn't necessarily wrong. Okay, I don't want to say that. It's not wrong information, but it's very level one type of thinking. And you have to understand that a lot of these resources that are put out there that are designed and focused to retail traders, well, they're kind of there for a reason, because a lot of this is put out by smart money, by institutions, by banks, by hedge funds. Smart money gets their money. They make their money off of the dumb money. I've done videos about this before in the past, and a lot of that information actually helps them and not us, the retail traders. So let's get right into it. Let's dive into it. So number one, knowledge is power. At first glance, yeah, absolutely. So what they're saying here in this is keeping up to date with the latest stock news, the Fed, all of this. And I don't disagree with that. But the one thing that I will say for people to keep in mind is that news, they already know, all of these institutions already know what news is coming out. You have to remember these are very powerful organizations. So I'll give you an example. Let's say the stock right before some numbers come out. Numbers is a really big one. It's not so much news and the Fed, it's numbers, jobs reports, all of that sort of stuff. As it starts coming into the time where these numbers are going to be released, you might see a big sell-off or a big rip up. Well, they're going to drive that right before those numbers come out into a valid support level, a level where the smart money will be buying. And a lot of people will freak out, and it'll come right into that. And I want you guys to start noticing that and really paying attention to that. They'll drive it right down into that. Freaking retail, dumb money out. They'll bail on the position just to have those numbers be released. Once those numbers are released, it's going to tag that level, that support level or resistance level, and rip straight up or dump straight down. And you'll see that all the time. And once you start noticing these things, you can use it to your advantage. So knowledge, of course, is power. That is not anything that you can really discount. But what you do have to realize is they're well aware of these numbers that are going to come out. They already know what the numbers are, folks. Again, these are powerful organizations that have a lot of money and a lot of friends in a lot of high places. So knowledge is power, but just remember that there's generally an ulterior motive when there's money involved. So not a bad point, but at the same time, let's use our heads. So number two, set aside funds. Assess and commit to the amount of capital you are willing to risk on each trade. Many successful day traders risk less than 1 to 2% of their accounts per trade. Yes, that may be correct, but when you are giving advice, like they said, to beginning traders, if you are very undercapitalized, there is no way you can only risk 1 to 2%. Now, we have designed a system for risk. It is our risk strategy as well as our sizing strategy. And at the beginning, off of a $2,500 account via options, trading options, but we don't trade options in the traditional sense. So don't get freaked out with the word options. You have to risk 4% of your account, and it will go up to as high as 11% of your account. That is the nature of the beast. So for them to tell you to only risk 1 to 2% is absolutely unrealistic. It would be very difficult to do, and it would be impossible to do via equity, which are stocks. Okay. And that's really what they're telling us here is new traders are going to trade stocks. You're not going to have the size of account that is able to only trade or risk 1 to 2% of your account. That is the reality of this, folks. So keep that in mind. I know they give you some numbers here about max loss per trade and all of that. Those numbers that they give you on this sort of stuff is just like, those are just made up numbers. They may make sense at first glances, but keep in mind, it's just not the reality of the situation. And you really need to learn from a true professional that has been down this road, has started with a smaller, undersized account and has grown it. Generally speaking, you wouldn't want to necessarily learn from someone that, and this might come out off the wrong way, but just hear the words and not exactly, what I'm saying or how I'm putting it. But you wouldn't want to learn from someone that, necessarily came from money. They started with a massive day trading account and then grew it from there. That's easy peasy, man. It's a lot easier than someone that is started with a small account and has grown it to millions of dollars through the years. And that's someone that I personally would want to learn from, because that's where I started. I started with a very small account and then grew it after blowing up twice, 2 small accounts, and my last account finally getting my shit together and then growing it. But yes, we need to set aside funds. We need to have a plan. Absolutely. So let's continue. Number 3, set aside time. Day trading requires your time and intention. Yes. And the one thing that I will say when they continue here, in fact, you'll need to give up most of your day. Bullshit, man. Absolutely not. I trade the first 30 minutes to 1 hour of the day, and that is it. Now, for a new beginning trader that is learning, yes, you obviously need to set aside way more time. You need to be fully dedicated to this. A lot of people think that they can just kind of like waltz in and walk into this and kind of do it as a hobby. Oh, I'm going to make some money off on the side. It doesn't work like that. This is going to take a lot of dedication and a lot of time. But as for actual trading time, I don't want you sitting in front of the monitors all day long. The more that you are in the market, where you are actually involved in a trade, the more risk that you have. You are exposed. You want to limit that. So keep that in mind. So number 4, start small. Of course, as a beginner, focus on a maximum of 1 to 2 stocks during a session. Tracking and finding opportunities is easier with just a few stocks. Yes, I cannot, there's nothing I can say about that, that I would put down or discount. I'm a full believer. Now, the one thing I will add to this, though, is a lot of traders will focus on 1 to 2 stocks per session, like per day. But then the next day, they're focused on other things and they're going off of scanners and all of that. And that's not going to help you at all. Each one of these stocks that are out there, they have their own personality. If you start looking at each individual ticker as almost like a living, breathing animal, you'll start to understand it a little bit better. Like Apple will trade differently than AMD. AMD and Apple will trade differently than the market, like SPY or Qs, and so on. You can keep going. They all have their own personality, because a trader with a certain personality type will flock to Apple or AMD. And I'll give you an example of that. Tesla is a stock that becomes extremely volatile, right? Well, who trades Tesla? Well, a lot of new traders that are looking for that huge money, the greedy. Now, I'm not saying that only the greedy trade Tesla. That's not what I'm saying. But what I'm saying is you will generally have more greedy, newer traders involved with Tesla looking for those big gains than you would with, let's say, AMD or Apple or MU, stocks that for the most part don't have that much volatility. They can and they do, and I trade those almost daily, but you see what I'm saying and where I'm going with that. So number 5, avoid penny stocks. You're probably looking for deals at low prices, but stay away from penny stocks. These stocks are often illiquid, and the chances of hitting the jackpot with them are often bleak. And I can't disagree with that for the most part. But the one thing that I will say is there's opportunities everywhere, guys. And for them to just lump in penny stocks into all being illiquid, that's not correct. And I know that they didn't say that all of them are illiquid, but they're giving that impression. There's a lot of actually really great companies out there that may be trading in that $5 or $10 and less price point. Now, we swing trade penny stocks very often, but they're not the low float. What they should be telling you, instead of saying avoid penny stocks, and I know it's designed for new beginning traders, but what they should be telling you is avoid low float. And the float is the available shares. And a low float stock is anything that is under 10 million shares in the float. And 10 million can still be stable, but you got to think, guys, 10 million shares is not a lot. I know when retail traders hear certain numbers, we think of it from our day-to-day life standpoint, like, oh, 1 million shares. That's a lot. It isn't. If you do the math, and I actually have an old do the math webinar that I did years and years and years ago, where I start breaking down float, and it really puts things into perspective. It's very easy for even one trading service to entirely cycle that float or buy up that float of that stock. And that's pretty crazy. You don't want that. I know some people, like with GME and AMC, they basically bought up that float and they started to manipulate it. It's not a good thing, guys. The only people that are making money are the ones that are running that room and that service. So keep that in mind. So number 6, time those trades. Many orders placed by investors and traders begin to execute as soon as the markets open, which contributes to price volatility. A seasoned player may be able to recognize these patterns at the open and time orders to make profits. For beginners, though, it may be better to read the market without making any moves for the first 15 to 20 minutes. I have no problems with that. But what I will say is when you are learning from a professional that knows how to, and it's not about recognizing patterns, that pattern bullshit that, Tim Sykes and all these guys have talked about for years. And I'm not saying that there aren't patterns. There's absolutely patterns, right? But it's not about patterns. It is about strategy. And strategy keeps you safe. If it fits your strategy, you can execute it. I prefer to trade the first 30 minutes to 1 hour of the market open. And for the reason that they're saying to be afraid of volatility, it's not so much the volatility that we want. We want volume. Where you have volume, but you don't have a lot of extra traders in it, it's just high volume, low number of traders. So just hear me out where I'm going with this. So when you have that, you have less people making decisions. Okay. And this is where how my mind works. If you start getting involved with these trades at like 10 o'clock, 11 o'clock, noon, and so on, what you have is way too many people that are in that position on that day on that stock. Do you see how many more variables will happen when you have all of these people on that stock doing whatever the hell they're doing on the day? There's so many variables because there's a million different people making a million different decisions, basing their trade on a million different things. Instead of the first 15, 20 minutes, you're going to have a specific group of people that are in that are making fewer decisions. So I hope that made sense. Okay, so number 7, cut losses with limit orders. Oh my God. What do they think you're doing? Do they think that you are trading millions of shares? Do they think they've already warned you to stay away from illiquid stocks? So if you're trading proper stocks, guys, this is where I have a real big problem. This is probably the number one thing that really pisses me off. They're putting really stupid, just like dumb information into your heads. And I've had to battle people that go on to Investopedia and they start learning and they start picking up on really bad information. Myself, I do not use limit orders, and I'm going to tell you why. I trade the most liquid stocks and options in the stock market. And if you think for a second, even with the positions that I'm trading, and I'm trading very large options positions. Now, I trade options, but you can look at it from stocks or options. It doesn't matter. And a lot of people will tell you that options are illiquid. Oh, no, they're not. Just look at the level 2 and you will see thousands, tens of thousands, hundreds of thousands of contracts, options contracts that are just waiting to be bought and sold. They are the most liquid vehicle out there, guys. Okay. So what they're telling you to cut, or why they're telling you to cut with limit orders, is so you don't get slippage. Okay. You get executed at that price. Okay. So if you set a limit order and you need to get out and it blows past your order, you're fucked. It's going to keep going down or keep going up if you're short. You're screwed, guys. Do not do that. Don't worry about slippage. I don't want to hear anyone in the comment section talk about fucking slippage. You don't know what you're talking about because you are trading too small of a position for you to get slippage. If I'm not getting slippage with thousands on some positions of contracts, okay? Mainly hundreds, you're not going to get them with the few contracts that you're trading, guys. It's not going to happen. Or even with the couple few thousand shares that you're trading, guys. If you're trading proper stocks that are liquid, you do not need to worry about slippage. I don't want to hear that. So do not use limit orders. Use market orders. Get executed immediately. And any true professional that actually knows what the fuck they're talking about will tell you this. Okay? Period. Full stop. Anyone that will argue with that does not know what the fuck they're talking about because they're not thinking about it clearly. Or they're trading garbage. That's why. That's why they cannot use market orders. You're going to get slippage if your spread between the bid and the ask is huge. Well, what the fuck are you doing trading that? Okay? So I have major issues with number 7, cut losses with limit orders. Do not use limit orders. You're going to get screwed. So number 8, be realistic about profits. A strategy doesn't need to succeed all the time to be profitable. Many successful traders may only make profits on 50 to 60% of their trades. Yes, I have really not much to say about this, but technically you can actually be a profitable trader at a 30% hit rate. So remember that as long as your risk reward is correct. Now, if your strategy is only pulling 50 to 60% win rate, being profitable on those trades, you're doing something wrong and you need to get better at it. Now, I'm not saying that during different market conditions, your strategy can have a lower hit rate. Of course it can. That's the nature of the beast. Don't be pissing around with your strategy. Leave it alone. If you have a valid strategy that generally hits anywhere between 75 to 90% of the time, depending on market conditions, you're good to go. And sometimes during the year, if whatever happens, it goes down to that 50, 60%, you're okay. Okay. So don't worry about that. I really have nothing to really go against what they're saying about that. So number 9, stay cool. There are times when the stock market tests your nerves. As a day trader, you need to learn to keep greed, hope, and fear at bay. Decisions should be governed by logic and not emotion. Now, I have no problems with that. Of course, you need to control your emotion. But the problem that I have with all of these sites like Investopedia and even trading services that are out there, they'll tell you need to trade like a robot. How, motherfucker? That is impossible. We are not robots. We are human beings. We are emotional beings. Okay? So what it comes down to is putting safeguards in place. And what are those safeguards? What are those barriers to help that trader keep those emotions under control in that trade? So people throw around these tips and tricks for traders and new traders. And again, at first glances, it looks really good. But the problem that I always have with it is they'll only come to you with problems, or they'll just give you the answer, but they won't actually give you the solution. So this is what is very different about how I roll and how I run my service and coach my traders. I don't just come to them with problems. I come to them with actual solutions to help them manage their emotion and, have their trading under control. So I don't have anything negative to say about number 9. Stay cool and, manage your emotions, of course. But come on, Investopedia, let's do a little better. Let's give people a little bit something, right? So I'll give you guys a little trick. And this is just a very minor one. If you find that you're really emotional in these trades and you keep cutting them too quickly, number 1, you need a proper strategy in place and a risk strategy and a stop strategy, all of that. But one thing that you can do is what I recommend for traders to do that are really having problems clicking that button too quick. Get up and stand back 5 feet from your desk or wherever you're trading. Now, I know that might sound silly, but what's going on there is it's putting in a psychological barrier. You're going to have to walk those 5 steps, which literally takes you no extra time, but it will make you think twice instead of hovering with your hand on that mouse with your index finger ready to click off, right? So it's just one of many things. That's a very minor one that I'm just giving you guys. There's obviously, dozens and dozens of more tips and tricks that I give that actually show results. So just wanted to give that out to you guys. Number 10, stick to the plan. Successful traders have to move fast, but they don't have to think fast. Why? Because they've developed a trading strategy in advance. Stop. Time out. But they don't have to think fast. That's fucking retarded what they just said. Of course you do. You need to think on your toes. Why? Because the market, even though you have a strategy, yes, and you have whatever in place, that market has a million different variables. And those variables can turn on you very quickly. And you can have a collection or a number of variables that come into play. And you need to be thinking ahead. And you do need to think fast. So don't let them fool you. You do need to think fast and you do need to be on your toes, regardless of strategy. But yes, you need to stick to a plan, obviously. And again, when they say it is important to follow your formula, it's not a formula per se, it's a strategy. I have a problem with the word formula. I'm not necessarily going to get into right now because that could be a whole video on its own. A lot of people like to apply a mathematical formula to this. They think that day trading is very analytical, and it can be. You do need to have a strategy, but it is more practical and hands-on and more art than people realize. Day trading is an art form if you take this seriously and you actually are pushing towards goals. You'll understand what I'm saying with that. You need to feel a flow. You need to be in tune with the market. You need to really it's not just about a formula. A plus B doesn't always equal C. Okay. There's variables and there's dissection. It's more art than it is mathematics. And I know a lot of people will disagree. I'm talking retail day trading. I am not talking institutional and smart money trading. Yes, that is way more analytical and there is a formula. Okay. But there's also art to that too. It's design. It's chess. So just keep that in mind. So that is the Investopedia's 10 day trading tips for beginners. I hope you enjoyed my take. I do plan on doing more of these reaction type of videos where I'm going through and dissecting what Investopedia and some of these other market information vehicles have to say, and the information that they're giving new traders, because a lot of it at first glance is, yes, it is correct. But what they're saying in the actual information that's going on in there can actually be quite damaging. And there's nothing more that I want than for new traders to actually be able to do this. And it's one of the reasons why I do this. And for some of you that are just discovering this YouTube or Twitter or X or Facebook, wherever you're finding me, one thing that I hate is when people call me a YouTube trader or something like that. I am far from that. I have found a level of success that people only dream of. And one of the things that I always told myself at the beginning 10 years ago, that if I got to a level, or when I got to a level of success, I would always pay it forward. And that's what I'm trying to do with this. For people that know me, they know that I live a certain way and I have found that success, and I just want to help give back. So that's why I put these videos out. So don't lump me in the category of creator or YouTube trader. The majority of those people live in their mother's basements and have not and never will find success. You can tell and you can hear by the words that they use and how they describe the markets. And I don't want that for you guys. I want you to follow reputable traders that actually have found success. Just look at the way that that person lives. If they don't show you how they live, and I'm not talking about bullshit like renting Airbnbs and calling it their own. Everything I own. It's paid for cash. I don't owe anybody anything. So find the right person, someone that has legitimately found success. Not asking, hey, mom, do you have dad's car keys, and trying to pawn it off as their own vehicle. That's gross. And I think it's deceptive. And there's nothing worse on the planet than a dishonest person. And I want to help traders find that success. And I look forward to doing more of these videos with you. Ciao. Adios.